This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. David welcomes back financial advisor Mike Shudel to discuss the unique challenges high net worth families and business owners face in planning for succession, taxes, and wealth transfer. They unpack why no single advisor can cover all the complexities, the importance of building a coordinated team, and how research-backed models, like the one from the Wharton School of Business, help manage risk for retirees and entrepreneurs alike.
Once again, joining me in the studio is our resident authority on all things when it comes to estate transfers, estate taxes, and business exits, etc. Mike Schudel, how we doing, brother?
Doing great. Thanks for having me back.
Absolutely. So, look, excited to have you in. We just hosted our second what we call business tax planning class. This is for entrepreneurs that are growing their business or someday planning to exit, or maybe not planning to exit, but need to have the tax planning done in case that exit is forced upon them. That we had really glowing reviews from that event. So, talking about that, we're seeing so many higher net worth clients that have come to the realization they're just not getting everything they think they're getting from their current advisory firms. And when it comes to tax planning in particular, we've kind of shined on that. In fact, you have now taken the reins and you're leading our private wealth division, which is really for people that have at least $5 million in liquid net worth or higher, because one, they have some unique challenges we have to provide for them. They have definite estate planning issues we have to provide for them, but they also don't realize all the things that are available for them. And look, I know everybody listening is not $5 million in net worth. There are some investment products that by law are precluded from you investing in unless you achieve this level. It's called a qualified investor. And so now you're leading that division to help people understand how to get true diversification in their investments. And I mean, we're talking about everything from the NFL now to private equity, private credit, all kinds of things. But anyway, talk a little about the experience of working with some of these higher net worth clients and business owners who've come to the realization they don't understand maybe the sort of risk they're taking.
Absolutely. So when you're dealing with these high net worth business owners, the complexities start to just layer on top of each other as they get closer and closer to wanting to wind that up and either transition the business internally to, key employees or maybe even family, or to sell it externally. So they are looking for an advisor that can tie everything together, the tax knowledge, the investment knowledge, the estate planning knowledge. It's just very difficult to source all of these specialties individually in one person that's good at just that area.
Well, even we can't do that, and that's the thing.
No.
There is no one man Superman that can be all things to a client.
It's
when
impossible.
It comes to the complexities of today's financial planning. And you don't have to be high net worth for that to be true.
No, but the turnkey for us that we found at Retire Smart is you do need a team. Absolutely. I've never met a high net worth person, and I'd say that's anybody with, frankly, over $1 million that didn't have a team. An attorney that's helping them build their estate, their wills and trusts, a CPA that's giving them coaching on, some of them are just historians just doing their tax return year by year, but some of them are a little bit more proactive. But to have that one person that understands and is fluent in all of those different languages,
all those relationships,
yes, I would offer that with the training that you insist that all of the advisors do here, not only Monday mornings for 4 hours a day, but also for 3 hours on Fridays. I've never seen another firm that does that kind of level of training.
Well, we do dedicate a lot of time to that, but that's just it too. And then we have someone take the lead, become that resident authority on various issues. We've asked you, you do have a law degree. You do not practice law. I'll cover that, but you are intricately trained to understand not only inheritance tax, like here in Nebraska, but estate taxes for multiple states, because there are states that still charge those things. My home state where I was born in Baltimore, Maryland, is the only state left that charges both an inheritance tax and an estate tax. And people are like, wait, what do you mean? What's the difference? Well, one's taxing the beneficiary, the other one's taxing the estate before the beneficiary gets anything. Right. And then you have to deal with federal estate taxes, which are at least for the near future are not an issue for a lot of folks, but we know that's likely to change within 1 to 2 election cycles, right?
Right. So let me just offer this. Having somebody on your team, and it could be any one of the advisors technically, it could be the attorney, it could be the CPA, it could be your financial advisor. but more likely than not, the financial advisor is going to have as much fluency in all those areas as possible. And something that I am delighted to do for my clients is get on the phone with their CPA, get on the phone with their attorney after that planning has been done so that there's synergy in the plan and there's no adversarial relationship going on. I want to collaborate with these people to deliver the best outcome for the client.
It's actually critically important that you collaborate. Otherwise, something the financial services professional, whoever you're working with, does could be counterintuitive or counteract something the tax professional is doing, or the estate planning professional, or the business attorney, et cetera. So, if you're an entrepreneur, you need a business attorney. If you for your state, you need an estate planning or elder law attorney. You're going to need financial advisor to help you on the asset allocation and risk management, and then you're going to need a proactive tax team to help you not only file and prepare your taxes, but proactively plan your taxes. So the complexities that go into this are quite enormous. Now, one of the things we believe in here is research, right? And we always joke when you come on, you have more letters behind your name, literally, than there are in the alphabet. I mean, 9 different designations or whatever it is at this point. Can't even read them all off. But the reality is we like to go to research. We believe in institutional research. And so from Stanford University, we've talked about some of the research that they've provided for us. Pennsylvania, UPenn, right? Ivy League school, Wharton School of Business and Finance there. I've been blessed to do a preceptorship there, et cetera. And that's how I build out the model for the risk assessments that we do for clients, is following what we call the Wharton model. Can you talk a little about how that applies, especially no matter what your net worth is?
Absolutely. So the Wharton model is something that, we want to have a standard that we can define how we approach things. And the Wharton School of Finance has done a tremendous amount of research. Specifically, what we're paying attention to is for the senior community. People, don't get me in trouble for putting some people in this camp, but basically people 50 and over.
Hey,
that's not to say you're senior. I know I'm going to step in it there, but nonetheless, if we could move beyond that.
Well,
the point I'm
I guess
trying
I
to
can
make,
be proud that my hairs are gray. I still have my hair. So
hey, I'm knocking
cool,
on
right?
the door, and so I'm paying attention here. But something that we need to acknowledge is these people don't have the luxury of so much time to recover from a major market shift. And we are in one of the 3 most overvalued markets
traditionally
in market
absolutely.
history. Now, as I love that you've pointed out, that doesn't demand a market correction. But what will happen, no matter what, is earnings have to catch up with stock prices. Right. That either means that we pause for a little bit on growth and earnings catch up, or the growth goes the other way, and that's how we catch up.
Well, the reality is most of our clients, it's not an issue of them running out of money. Our clients are ending up with too much money or too much income. We talk about forced income all the time because they end up saving the predominant amount of their money in the wrong tax bucket, if you will, that deferred tax bucket, the 401k, the IRA, and they're forced these big distributions when they get into their late 70s and early 80s, $100,000 forced, what we call RMDs, requirement distributions. They don't want the money, right? And it's all taxable, and it makes them pay more for Medicare services, B and D. So there's all kinds of penalties here, and they end up transferring way more wealth than they ever thought they would to the next generation. And without proper planning, those transfers can be absolutely disastrous. Now, we're not going to do any celebrity ones here, but we've talked often over the last couple of years between you and Colin, the estate planning attorney, coming on the show of some of these celebrities that have just completely messed up their planning. But what the Wharton model is saying is sequence of returns is what you have to understand. We've had an amazing bull run for about 15 years now. But if you happen to time your retirement during the next downturn, and of course we don't know, we're not saying when that is, and people don't realize how much a downturn can be because we haven't seen one in a while,
Not really since 08.
Yeah, so 08, 09, the markets went down over 50%, and a lot of people forget that. I started my career in the 90s, and very early on, within 2 years, we went through the worst bear market of anyone that's alive today. 3 consecutive years of negative double-digit returns. And if you're following, and I joked about last week, we covered on the show, the gentleman that invented the so-called 4% rule said, oh, now maybe it's the 4.7% rule. And I said, no, not so fast.
Wrong direction.
Because if you took 4.7% out and inflation adjusted and happened to retire January 1st, 2000, you're out of money here in 25. You have nothing left in your portfolio. And so we want people to understand why we look at research, why we believe in these institutions, because they backtest this stuff for over 100 years. And that's what we're trying to help people understand is your assets, we want to provide income in retirement regardless of your net worth. but you have to have a plan that reaches out and does risk management, asset allocation, tax planning, and then legacy planning and passing the assets on, and include medical and healthcare, which we're not talking about in this segment. But so anyway, bottom line is you teach one of our most popular classes called Tax and Estate Planning, along with Colin Kastrick, who is an estate planning practicing attorney. When is that next opportunity?
Yeah, it's coming up a little ways from now, Tuesday, November 11th or Thursday, November 13th, here in our offices at 6:30 p.m. Now, you don't need to come to both classes. It's the same content each night, but that way we can have as many people attend as possible.
Excellent. So go to retiresmartnow.com, click on the events tab to attend an event. You do have to register the classes. Do fill up. Mike, we are out of time for this week. Thanks so much for stopping in.
Thank you.
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week. Financial advisor Mike Schudel has a Juris Doctorate law degree but is not licensed to practice law. Any statements and opinions are general information and not legal advice.